Keith McCullough, and welcome to another Real Conversation. Apologies for the late start. We had some technical difficulties there, which happened. I guess technically people have some difficulty understanding the difference between trending and transitory inflation. Welcome, Steve. I know you have some thoughts on that. You know, I get asked about it all the time. I say trending, they say transitory. I think you say trending, and you say it more aggressively than I say it, so that's why I was quite interested in having this conversation and getting into what you have that a lot of people don't have, which is an actual process to measure and map it. So let's just start with that.
Okay, good to be with you again, Keith. This big debate about inflation is very interesting because it really is all about money. Remember, Milton Friedman told us long ago that inflation was always and everywhere a monetary phenomenon, and that is correct. And from my perspective, I'm a member of the monetarist tribe, and Milton Friedman is the chief of the tribe. Now, we're debating inflation. Is it transitory? We've seen all the inflation numbers are up. Any way you cut it, all prices are much higher than the consensus of so-called experts thought they were going to be, whether it's consumer prices, producer prices, commodity prices, you name it, right across the board. They're all very elevated, as high as they've been for 10 or 15 years. Now, the transitory argument is being put forth primarily by the Federal Reserve and the establishment, and that is they poo-poo all this, and they say, "Oh, look, it's transitory. These prices are gonna go away. We've had the COVID problem, so that meant that a year ago prices were quite low, abnormally low. They plunged after COVID hit. And that means you've got something called the base effect. And if you calculate any price change off those abnormally low bases, you get a big number. I mean, it's just the arithmetic of the thing. So that's true. That part, the base effect, is transitory. In another couple months, that will be gone and out of the picture. So that is one point. The other point is the supply chain type problems that we have. The economy is now cranked up, and demand is very hot in the economy, mainly because of the money supply pump, which we'll get into. But it is hot. Demand is hot, and supply is got some kinks in it, and the supply chain has been broken and distorted in various places. So you get all kinds of odd things going on, and those temporary shortages are temporary, transitory, they'll adjust. So that's part of the picture. But underlying it all is a huge increase in the money supply, broadly measured. And we'll just use, for purposes of our discussion today, M2 is the broadest measure of money that the Fed actually measures. If you want a better measure and a broader measure, you can get Divisia M4 from the Center for Financial Stability in New York, and Professor Barnett, Bill Barnett, is the guru on that, and that's actually the best measure. But let's just use the Fed's M2. The last 17 months, M2 has been growing at an average rate year over year of 20.1%. That's about 3 times higher than it should be if the Fed wanted to hit its inflation target of 2%. So money growth is very, very hot. And what does this mean? In monetary analysis, and by the way, the key equation here is MV, money times velocity, equals P times Y. Now, P is the price level, and Y is real GDP. So the P times Y is the nominal GDP in the economy. And the best way to predict nominal GDP in the economy is to look at what's happening to the money supply, broadly measured. And if we do that, we come out with figures that historically have been right on. If you look at 1961 to 2019, Keith, the M3, then that was the broadest measure, was growing at 7.4% a year, and nominal GDP, that's the P times Y thing that I mentioned, was growing at 6.5. 2000 to 2019, M3 was only growing at 4.5%, and nominal GDP was only growing at 4.1%. So these things match up. The MV equals PY is the equation of exchange, and that's kind of the theory of everything. If you want to know where the economy is going in nominal terms, that will get you there, and that nominal number is split, of course, into real GDP growth and inflation. So we've had this big bump up in the money supply, big monetary injection. Then what happens? In monetary analysis, we've got a lag. And the lag for asset prices going up after the monetary injection is about 1 to 9 months in the United States. And what happened? After March of 2020, when they started goosing the money supply, what happened? Stocks rebounded and went up. Housing prices have surged. Those are assets. Commodity prices have surged. Asset prices going up. The next phase is that the real economy starts booming after you inject money into the system. And the lag there is about 6 to 18 months. And what are we seeing now? Just yesterday, the Atlanta Fed revised their estimate for economic growth in the United States to, on an annualized basis, 10.2%. I should say 10.5%, 10.5%. They had it at 9.1%. Now they've bumped it up to 10.5%. If you take the last quarter, the second quarter, and annualize those numbers, you get 10.5%. That is unbelievably hot, real growth. That's real. So that's the second phase, and the third phase is inflation. That's what Milton Friedman. Inflation is always and everywhere a monetary phenomenon. That kicks in after a lag of 12 to 24 months. So where does that put us? We get rid of all this transitory stuff, but then the real inflation, the trend inflation, starts hitting the system. And so I have, for 2022, using again the quantity theory of money and the little exchange equation I gave you, working out the numbers, you get something a little under 5% for the inflation rate in 2022. 2023 and 2024, you get a little under 6% inflation. That's for the consumer price index. So we've got a lot of inflation baked in the cake already. That's using the money supply growth numbers that we've observed in the last 17 months of running about 20%, Keith. Mm-hmm. So that's the story. I mean, it's just arithmetic and logic. I mean, you've got to have a model for national income determination, and the monetarist model is the most reliable one. That's the one I'm using. If you read the press, you have everything under the sun. They're talking about all this temporary stuff, the fiscal spending, this thing, that thing. They never mention money and the money supply. It's all about money. Money dominates.
Yeah, and thank you for that. I mean, that is a professorial explanation, knocking down the pins and including, the big components of the debate. So I think obviously what frustrates you a little bit, or at least I'm sensing that, and it certainly frustrates me, is A, all of these experts now, like you said, that didn't see inflation coming are the ones that are going to tell us how transitory it is. And B, you have everybody with an opinion obviously has a qualitative view on different things from lumber to whatever, but they don't have a model, and a model that works. And yours obviously has over the years on this. Just to take them step by step, I just want to say what at least our model would agree or disagree with. Base effects, number one. Yes, those are transitory. You could also call them cyclical. The base effects are always a fact of the matter. They are always a starting point in terms of how I measure and map both GDP growth, nominal or real, and inflation. That's what we do. That's my job. Two, on the supply chain, I'd call that cyclical. I mean, you can call this word transitory gets a lot of airtime. It's just cyclical. Supply goes up, supply goes down. But it doesn't mean it goes away. It doesn't mean that the supply issues just go away magically after 2 months of inflation prints. And then finally, the most important thing, which is your edge, I think, is the money supply side. I don't spend enough time on that, Steve, and I'm admitting that obviously publicly here. I spend more time, and I want to get your thoughts on this as well, which is a function of the money supply. So I come at it a little differently, but I spend a lot of time on the rate of change and the value of the U.S. dollar, and I obviously spend a lot of time on labor inflation. So which is not. That's another component of late cycle component of sticky inflation, as you know. So I wonder, where does the dollar part of this, because the dollar part does capture the monetary policy and it certainly captures the money supply growth.
Okay, I agree. You have to do those things that you're doing, Keith. I don't have any problem with that. The point that I would raise that everyone misses, and it's just beyond me why, is the fuel that's behind the whole thing. It's money.
Yep.
It's always money. And money dominates. When I say money dominates, think about this, Keith. Everyone looks at someplace like Japan, and Japan has been running huge fiscal deficits for decades now. And they have the highest debt to GDP ratio of any of the advanced countries by a country mile. And so a lot of people say, oh, gee, they're going to have huge inflation. Inflation's going to break out there. No, they've been in a deflationary environment for decades because why? They haven't monetized that debt and deficits that they've been running. And the money supply grows very slowly.
Right.
Money dominates. They have had loose fiscal policy, unbelievably loose fiscal policy. The monetary policy has been very tight. Broadly measured money supply, M3, has hardly been growing in Japan. And they have, of course, no inflation. And the economy has been more or less stagnant, too. Now, take another kind of natural experiment where you can show how money dominates the situation, not fiscal policy. You read all these things about concerns that the Keynesians, for example, Professor Larry Summers, former Secretary of the Treasury, has been getting a lot of press over his concerns about inflation in the United States. But that's based on a Keynesian model. Summers is always talking about the fiscal deficit that's almost 10% of GDP in the United States, and that's bothering him. And he's concluded that will lead to inflation. Well, it will, in a way, because the Fed has been monetizing virtually 100% of that deficit, and that explains a large part of why the money supply, M2, has been growing the last 17 months at about a 20% rate. So if you don't have money in there, you're just not going to be able to figure out any of these micro things that you're looking at, any cyclical things, any supply chain things, and so forth. The one thing I would say, looking at the supply chain disruptions and whether it's cyclical or not, if you look at commodity markets, a lot of the commodity markets, what happened when COVID hit, everyone hunkered down and they started running down inventories that they had. Inventories shrunk and they stopped virtually all CapEx for any kind of development of mines and raw material production facilities, that sort of thing. So today we have had quite a boom in commodity prices since the money supply started surging. And we can see still that's going to continue if you look at it analytically, because a lot of these commodity markets are in what we call backwardation. The spot price or near-term prices are quite a bit higher than the futures prices or the longer-term prices are. And that's just a signal that there's a tremendous near-term shortage and inventory shortfall in those commodity markets that are in backwardation. That's why oil, you look at oil, there's a shortage in an inventory sense. They've run down inventories and they're low right now. Copper, you end up with the same picture in copper and on down the line. They're all in backwardation, indicating a lot of inventory shortage. So that comes into the picture because you've got an inventory shortage. You've had very little capex in those raw material producing sectors, and at the same time, we have demands being goosed because the money supply is being goosed, and we know that demand is on a tear, because if you look at, for example, the last 3 months, retail trade expenditures and food and services, that sector, it's growing at an annualized rate, if you take the last 3 months, of 50.5%. This is, you've never seen numbers like that. So the real economy is in a huge boom. The demand in the retail and food and services sector, which is a big sector in the United States, is an unbelievable 50.5% on an annualized basis. Now that hits into the supply chain where you've got inventories that have been run down and are very low. And you don't need to be an economic guru to figure out that prices are going to stay very elevated in that kind of environment.
Well, that's
demand high,
that's
inventory low, supply chain disruptions, cyclical, whatever you want to call it, Keith. You just can't meet that demand with the supply available. Prices are adjusting upwards.
For people, it's a narrative that makes more sense than the numbers. Like if you had a pop quiz where the person's speaking on old wall TV or whatever, like you said, establishment econs, and you had a pop quiz on what is the equation that you're measuring and mapping money, you would come up with a variety of inaccurate answers quite quickly. Now, if somebody had some time to look it up, they still wouldn't know how to apply it. So that's why again, it's more of a frustrating thing to watch kind of macro tourists, I call it, just run with these narratives on this looks like that and this supply shortage over there. But there, like you said, there's some what's interesting about this is that there are classical, economic views and economic models that actually come to the same conclusion. Like, it's interesting to see, like, where I was educated, and I don't subscribe to it, Keynesian economics at Yale, that's the Summers view. The Summers view still has the same conclusion. Like, if you take, guys, show slide 48, I don't know if Steve can see it, but I'm just showing basically what you said, which is I'm inverting the deficit against the dollar. And it is a good leading indicator. If you continue to do that, print more and more money, and the velocity of money picks up, then that's a pretty good leading indicator to devalue your currency. I want to talk about that in a bit, but I do find it interesting to see, the narrative-based person is disagreeing with inflation. The Fed and the government, who can't afford, and neither can the Chinese government, acknowledge that there's inflation or they have a political problem. And then you have the actual numbers in my model. One more slide 15. This is a very interesting model, Steve. I don't know if you've paid any attention to it. You did mention the Atlanta Fed nowcasting process. Ours is better, a lot better. But all those numbers have done. Like, we started the year we're the only firm that had like close to 3.5% inflation. The most important thing isn't that the current quarter has gone towards 5%. It's the out quarters sticking inflation at much higher levels. So, yeah, base effect gets you to these last couple reports. But to me, it's really about, and that's why I say trending or sticky inflation, or sticky, could be sticky stagflation, whatever it ends up being. It's going to be inflation. I can't get, for me, like 2022 is a career from now. Like the back half of the year is something very interesting to focus on. And I can't get what the Fed or any of these people on TV are talking about, going back to 2. I mean, that's mathematically impossible.
Yeah, you're exactly right. And the big problem we have, in a way, is the Fed is a problem in 2 senses. In one sense, they don't have the money supply on their dashboard, so they are not looking at the money supply, and they tend to always be talking about interest rates. Now, interest rates are a very bad indicator of the shall we say, the shape or the tone of monetary policy. Forget looking at interest rates. Everyone does. You read the papers. Interest rates are basically just noise, because let's say that we want to loosen the monetary supply and goose it a little bit. What happens initially, interest rates go down, but as you goose the money supply, eventually you will increase asset prices, the real economy will crank up, and you'll eventually get more inflation.
Right.
And once you get more inflation, Keith, interest rates follow inflation. So interest rates on a sustained basis will go up. So you loosen the money supply, interest rates go down initially, and you say, oh yeah, we've loosened, interest rates have gone down, that's it. And then you forget about it, but inflation starts gnawing away at you, and pretty soon, what happens to interest rates? They go up, not down.
Mm-hmm.
So interest rates are a very bad thing to look at, and the Fed never talks about the money supply. Chairman Powell has actually testified that the money supply is essentially irrelevant in terms of its relationship to economic activity and inflation, which it's an astounding statement for the chairman of a central bank, but they're all saying that. It's an echo chamber. So if you go to Europe and listen to Lagarde, she's saying essentially the same thing as Jerome Powell. None of them have the money supply on their dashboard, and that is a big mistake and dangerous. The second thing, the second problem is that the Fed is obsessed with guiding and managing inflation expectations. They want you and they want me to think there's going to get back to 2%. They want to keep these inflation expectations anchored, because if they aren't anchored, and I'm running a business and I see the inflation numbers come up, and I listen to somebody like me or somebody like you on the tube, they say, gee, inflation's here. It's not anchored. And I'm going to raise my prices. And people that are entering into labor contracts say, I want my wages to increase to accommodate that 5% or 6% that Hanke's talking about. So that is a problem, because that is misleading the press. The press just repeats, by the way, what the Fed is saying. So the press is repeating that these are all transitory, don't worry about them. Most of the Keynesians are. There are exceptions like Summers. Now, Summers, in that sense, is an exception. Mm-hmm. He's using a Keynesian model, certainly not a monetarist model. He's a fiscalist, but he is coming to the same conclusion that the monetarist, orthodox monetarist model is coming to. And he's kind of a minority point of view in the Keynesian camp, shall we say.
You know what? It's an interesting majority view, which is quite literally, Steve, given what we've talked about so far, and you've so eloquently explained using math instead of names and narratives, is the positioning of Wall Street. They basically, hook, line, and sinker, accepted the Fed's view. And there are a lot of reasons for this. There are political reasons for this. As you know, some very large money managers are not Republicans. You have people that, if you do have trending inflation or generational inflation. In some cases, you call a lot of different things, but it's definitely different than where it's been. You have the positioning of the market, guys. If you show slide 10, the biggest net long position, Steve, in CFTC futures and options contracts in all of global macro is long the long bond right now. They've expressed this being transitory as buying their old deflation duration portfolio. And that's paid out for a long time. I got paid on that. I've been plenty of times. I've been in the deflationista camp, not deflationista. I've just been positioned for deflation because that's what numbers we're measuring and mapping to. How much of that has to do with the legacy? And I think you wrote about this as well. Like if you look at the average of M4 growth or money supply growth, between in the last decade prior to this year, it's much more benign than where it currently is now, and you've had much lower levels of inflation. Is it just your career risk management for a lot of these people? They don't want to make a call on sustained inflation because that really hasn't paid off for a decade.
Well, you're exactly right. The bond market is bought into this Fed narrative, as we would say. And hook, line, and sinker. I mean, the bond market is not showing up with inflation signals whatsoever. And all I can say is that these people are really going to get their fingers burnt badly unless they're fast on their feet. You don't want to be long bonds now. I mean, this is just almost insanity, I would say, because of the fact that inflation is baked into the cake, and we know that if you know anything about monetary economics. Now, most of the people, by the way, the problem is that it part of its institutional memory. You got a lot of young folks up there trading that have no memory of anything, almost, but they've never learned monetary economics. They don't even know who Milton Friedman is.
You don't think that they're talking on Reddit about Friedman all day long? You don't think that's going on? Just buy stocks. What they're actually doing, though, and again, you rattled off everything that we measure and map, obviously, that is actually inflating. And one of my favorite one-liners is the people that don't believe that inflation is here aren't long it. But even the 60 or 70 million, whatever the number is now, of new retail traders that are chasing meme stocks or whatever, that is the velocity of these moves is max money moving. Like this is like the whether they know Milton Friedman or not, they are actually in rate of change terms, on the same flywheel as the velocity of money itself. Would you agree with that?
Well, most of this trading is obviously momentum trades and looking at algorithms and seeing what tweets somebody has put up. I mean, it's not based on any fundamentals whatsoever. So
it's based on the expectation that the next price is a higher price, an inflated price, a higher,
Yeah, well, if you look at things like cryptocurrencies, for example. And this, by the way, gets back to the Fed, because who's fueling all this speculation? Cryptocurrencies are a highly speculative asset. They're not currencies. They're a highly speculative asset, and you put your finger on it. It's the greater fool's theory of investing. This isn't investment analysis. This is Hanke buying something today and in the expectation that I'm going to be selling it to Keith tomorrow at a lot higher price, and I'm going to pocket the difference.
Exactly.
That's all that's going on. It's not really based on any analysis, and if anything, it's just based on a lot of noise, and, as you say, various narratives. I mean, they have some voodoo expert. She's looking at a crystal ball. She's got millions of followers, and whatever she says, the cryptocurrency zig and zag depending on what this gal tweets out. It's just kind of mindless speculation.
Which is why, they need their leaders. They need Elon to bless it. The narrative needs to go on. But I do think it is all part and parcel based on inflation expectations, money supply growth. I think you've absolutely nailed that. The alternative to that, which you're one of the only people that have ever done the work on it and moreover implemented it. Like when you think of, and maybe explain it because not everybody knows what currency boards are, why they work, or why you thought of it, and why when you implemented it, why they work, why certain countries liked that kind of a setup.
Well, a currency board, there have been about 70 currency boards, a little more than that, and none have failed. They've all worked like a charm. Now, what is a currency board? It's a pretty simple institution. The currency board issues a local currency. That local currency is trades at an absolutely fixed exchange rate and is fully convertible with an anchor currency. Mm-hmm. And the currency board is credible, and that fixed exchange rate is credible because the local currency is backed 100% with the anchor currency reserves.
Right.
So the local currency really becomes a clone of whatever the anchor is. For example, in 1997, I was the president's chief advisor in Bulgaria. They had a hyperinflation at the time when I was brought in. The inflation was running at 242% per month. That's a monthly rate, not an annual rate. We put in the currency board, and the Bulgarian lev, which is a local currency, at that time, the anchor currency was the Deutschmark. And so the lev was backed 100% with Deutschmark reserves, and it traded at a fixed exchange rate with the Deutschmark. So the Bulgarian lev became a clone of the Deutschmark. And of course, inflation disappeared almost instantly. Interest rates collapsed almost instantly. And the reserves, the Deutschmark reserves, almost tripled in a period of 1 year. And the reason they almost tripled is that, to start with, of course, nominal interest rates were higher in Bulgarian lev assets than they were in German assets. And there was an arbitrage. And what was the arbitrage? Well, you'd borrow in German marks, you'd take the German marks into the currency board in Bulgaria and exchange them for Bulgarian lev and invest in Bulgarian lev denominated assets. And of course, it was a risk-free arbitrage. So they all always work. And when I say the local currencies become a clone of the anchor, the local jurisdiction, whatever it happens to be, Bulgaria or Hong Kong is a famous currency board. That one was established in 1983. John Greenwood designed that. Mm-hmm. And put it in. And so the Hong Kong dollar is a clone of the US dollar because the US dollar is the anchor currency and the reserve currency in Hong Kong. Mm-hmm. So inflation rates are about the same in Hong Kong as they are in the United States. Right now, of course, the Deutschmark's long gone and the euro replaced it. And so the euro replaced the Deutschmark as a reserve currency in Bulgaria. So Bulgaria's inflation is about the same as the average in the Eurozone.
Yeah, this it happened in Lithuania, Estonia. People laugh when I tweet about the markets in Bosnia. That it's like it's not a joke. These things actually happen. Like Bosnia, I think, is 1997 as well, correct?
Yeah, 97. I helped design the one in Estonia in 92 and the one in Lithuania in 94. Bulgaria and Bosnia were 97. So, and hopefully we'll be able to do a currency board in Lebanon. Lebanon is a basket case. The currency, the official exchange rate is 1,500 to the dollar, 1,500 Lebanese pounds to the dollar, and the black market is 15,500 to the dollar. So the currency has been completely wiped out. Inflation is at triple digits.
Yeah.
And if they put in a currency board that was anchored with the dollar, the inflation would be crushed immediately, and they'd be off to the races. So we'll see.
It's
We're
amazing.
proposing.
What's amazing is how much experience you have and fully loaded with the models that you're using and citing and actually implementing it versus, again, these views on inflation that have nothing to do with anything that's ever happened before, or moreover, what is actually happening with money supply and the actual inflation that's in the system or in your portfolio, which I think is a much better way to think about it. Again, just don't be upset about it. Don't call it names. Just own it. That's the way.
Yeah.
That's the best way to protect yourself against it.
See, one thing that people get confused about with the money supply, by the way, let's talk about the Great Recession, which started in 2008. So what happened? The Fed started quantitative easing. In fact, they had QE1, QE2, QE3, and many people had this narrative, because it is a narrative. By the way, there's a great book Bob Schiller wrote last year, Princeton University Press. That's the title of the book is Narrative Economics. Yep. And it gets into how these narratives get started and go viral and so forth. So one narrative that came out of the Great Recession, the minute the Fed started quantitative easing, people started hyperventilating, especially gold bugs started hyperventilating that we were going to have hyperinflation in the United States. But they didn't realize that the Fed is a small player. It's peanuts in the grand scheme of looking at broad money. Let's say M4, for example. Yeah. When the Great Recession hit, the Fed accounted for only about 9% of broad money measured by M4. The rest of it was privately produced by commercial banks. So the Great Recession hit. We had, of course, the bad guys. Remember then, the bad guys were banks and bankers. And we had Dodd-Frank piling in, regulating the banks more severely. And Basel III, in Basel, Switzerland, the central bankers club of clubs, bank of banks, came in with a higher capital asset ratio requirement, Basel III. And what happened? The elephant in the room, the commercial banks, that chunk of the money supply that they supply actually started going down. So you had this huge pro-cyclical thing happening. At the same time, we went into this slump because the housing bubble burst in 2008. The money supply component produced by commercial banks, what I call bank money, the 90% of the total was going down. It wasn't just slowing down. Yeah. It was going down because of all this regulation and nonsense in Washington. The Fed, fortunately, realized what was going on, and they started quantitative easing. If they had not, we would have had a Great Depression in the United States. Instead, what we had, the Fed mitigated the downfall in the money supply due to the over-regulation of banks. And the overall effect was broad money grew very slowly, only about 4.5%, 5%. Yep. And we never had any inflation. They never could reach their inflation target. It took us forever to get out of the Great Recession because why? The money dominates. Money matters. Milton Friedman and monetarism matter. The money supply was growing very, very slowly, contrary to everything you were reading in the press about quantitative easing and the explosion of the balance sheet of the Fed. That was true. Yeah. The Fed's balance sheet was exploding, but the Fed is peanuts in the whole game. Yeah. The big elephant is what? It's banks. Mm-hmm.
Well, when it comes to solving for V, M times V, I mean, you make it so simple, yet so many people cannot simplify the complex by just going there because, again, they have their whatever their educational bias is. But I mean, at the end of the day, if you solve for that, you can solve for what we're trying to solve for, which is the actual answer on inflation. I mean, M4 during the pandemic was growing almost 30%, wasn't it? I mean, the thing was ripping. So when you start talking about
M4 during the Great Recession, Keith, it was always growing about 4.5 to 5% per annum. So
Right.
that was a very slow rate. The
Yep.
golden growth rate, the rate of growth for the U.S. money supply, broadly measured to hit the inflation target of 2%, is about 6.5%.
Right.
So it was always growing even below the golden growth rate, and that's why inflation. The central bank couldn't figure out why they're not hitting the inflation target. Well, if they had the money supply on their dashboard, they'd see obviously the speedometer is way down there, not growing at all, and therefore we know that the nominal GDP can't be growing very fast.
Yeah, I mean those are important numbers to. Sorry to interrupt you, but important numbers just to repeat so people can. Because again, we want numbers, not narratives. We want narratives that are derived by numbers. Don't start with a narrative that you need something to be, you want it to be, you hope it to be. Again, the world's going to be the way that it's going to be in velocity terms. Einstein taught you this. The higher you go, the faster it gets. So velocity matters. Measuring and mapping the velocity, the lack thereof, or the accelerations, decelerations, that matters. So what Steve just said is really important. Like if you're growing money supply 6.5%, you're going to get the golden rule, I guess, is around 2% inflation. You're running less than that post financial crisis. But what I was saying was during the pandemic, you're running closer to 30%. Pandemic, like last year, running closer to 30%. And now that's really howling. I mean, that's the best number since like World War II?
Yeah, 1943.
Okay, there you go. So in order of magnitude, these numbers are dramatically different, and it shows you the step function of what people got used to. Like people started, like you said, they thought, okay, we got this 2008. They're printing more money than even God himself might be able to. That must be inflationary. No, not until the velocity of money took off. And still, throughout the 10 years post that financial crisis, you really were only growing the money supply at a rate that would keep inflation pretty much where it ended up, which is, I call that benign, or around the Fed's number, 2%.
Yeah, what the problem people run into, you say, well, depending on their education, most people aren't educated very well in this day and age. They don't learn monetary economics if they take a course in macroeconomics or money and banking or any of these things. So that there's a void in the educational system. Point number one, but point number two, they're reading the financial press, and my 95% rule, Keith, is that 95% of what's in the financial press is either wrong or irrelevant. This is the problem.
Yeah.
I mean, the average person is reading the financial press every day, and if 95% of what they're reading is either wrong or irrelevant, you got a big problem.
A major problem. Okay, here's one first, and we have some time for some questions if you have time for that, because I think like there's some people that are quite literally famous, and I think they should be for being in the deflation camp for a long time and consistently so, but are dead wrong for the last year. I mean, being long of inflation is the right way to have been positioned. That's a fact. If you bought commodities, if you bought anything that is linked to hard assets a year ago, you've absolutely crushed it. But the first question is from David Arden. Thank you, David Arden, for using your last name. We do appreciate people being transparent and accountable about what their actual name is. Isn't that a low bar? Isn't that a low bar, Steve, to get to? But David, good question from North Carolina, which is, and I get this question a lot, what is wrong or what's missing with Lacey Hunt's view of inflation?
Well, number one, Lacey's an old friend, but I haven't seen what he's actually written lately. He's usually using monetary analysis. I mean, Lacey's fundamentally, at least historically, unless he's switched gears on me in the last few months.
I don't think you switched gears. I think Lacey's very consistent.
Yeah. So what is Lacey saying about inflation? I just haven't communicated with him. I don't
know. Like, I don't start, to your point, with what other people are writing or saying.
Ask David. Yeah. Check with David Arden.
Yeah, we'll check. How about this one? Here's a good question, because again, I think Steve just answered his question with, like, again, people get bucketed, right, on Wall Street. Like, if you want to be bucketed as an inflationista or deflationista, you better get used to being wrong for like years at a time on both sides of this. Okay? So that's not what I'm in the business of doing. Like, we want to save money so that we can compound returns and make money. You got to be able to go both ways, Steve, which you obviously do. Here's a question from another Dave in California. Steve, how do you square your monetarist thesis on inflation arising from QE and persisting at least a couple of years with secular trends such as wage increases and greater bargaining power of labor, et cetera?
Money dominates.
Yep.
Again, the trends are the trends, but money dominates. So the overriding thing is going to be money. You have to start by looking at money, and then you can adjust and fine tune and tweak what you're getting for your expectation about nominal GDP. But the fundamental thing behind it and the foundation behind everything is money. The equation of exchange that I gave you is literally the theory of everything.
Yep. This I like how, what I love about it, I struggle with this, you didn't. I struggle with this because in the morning I do the macro show, Steve, which you may have not put up with watching. But in the queue, I might have this, 10 to 100 different ways to ask the same question. The answer doesn't change. Like when it comes to our process, your process is your process. It's money. It's measuring the velocity of money. That's it. You can ask Steve Hanke whatever you want to ask him in a number of different ways, and that's what he's going to say. Lacey Hunt, by the way, thank you. Tony in Indiana just gave us the update, which, again, not surprisingly, I think everybody labels Lacey Hunt as a deflationista. So Lacey Hunt's views deflation in the long run. Do you see that playing out, and does it even matter? Like in the long run, I don't even know what the long run is anymore. I mean, most people think that this is going away like tomorrow. If you're buying long bonds today, you must think inflation's done going up. It's not going to be here.
Okay. So to quote John Maynard Keynes, in the long run, we're all dead. So we that. But I do have 2025. Given this monetary explosion that we have had, remember in 2023 and 24, I said inflation would be probably a little under 6%. But then in 2025, it starts dropping down and you get down to about 3.5%. Wow. So that's not exactly deflation. It's actually a 1.5% over the Fed's inflation target of 2%, but it's certainly lower than 6% the year before in my forecast for 2024. But I'm not an inflationist or a deflationist, Keith. You hit that just right. I'm a monetarist. Right. And it depends on what's going on with the money supply, whether you're going to get inflation or deflation.
So on that, like what would I guess I don't see this question should be. I'll give you a question that should be highly voted in the queue. What will the Fed do? Not should the Fed do, but what will the Fed do to affect or not affect the current velocity of money?
Well, when we talk about velocity, by the way, that's a little bit tricky because
it's not just the Fed, right?
It's the money supply, really,
right.
not the velocity they're working on. But at any rate, I think what the Fed will do, they're convinced that this is a temporary thing. We're seeing these price increases, and so they pretty much will keep their eyes closed. They won't change anything. And once we get into 2023, they will realize that Milton Friedman was right, and that my forecast is right, and they're going to see inflation of 5, 6, 7%, and they're going to go, my God, what are we going to do now? And they will pivot.
You know what they did?
And when they do, by the way, that means by then interest rates will have gone up.
Yeah.
The bond market will have been killed because interest rates on a sustained basis follow the inflation rate, and so the bond market will have been already wiped out, and the stock market will be in big time trouble when the Fed does put on the brakes. Eventually, the multiples will come way down in the market, and you'll see the stock market running into pretty rough water.
If you're right, I mean, I think that if I'm right on this, I'm going to be right on that, and you're more hawkish than me in terms of what the inflation numbers you just rattled off. I mean, that's going to be really interesting, won't it, Steve? Let's say that somewhere in between you and I, there is the answer on trending inflation, 4 to 6%. Let's just say that just continues to get reported throughout this year and into early next year. Then they get their base effect. Q2 of next year, you're only going to have disinflation because of the base effect, right, Steve? Because next year you have to lap the tough base effect. So it's I bet. Well, I don't need to bet. I'll just have an educated guess that the Fed will not explain falling inflation for a quarter or whatever it is that way.
Yeah. Well, it's hard to tell what they're going to do because right now they have managed inflation expectations in the sense that the most important factor in markets anyway is the bond market, and the bond market is obviously bought into this temporary thing, hook, line, and sinker, and I think the bond market is going to be in deep trouble as a result of not understanding monetary economics, not understanding Milton Friedman, not understanding how the monetary system works is something that will come back to bite the bond bulls in the tail.
Yeah, and you've been crystal clear on how you think that through. Your process has always been crystal clear. Like you said, it goes both ways. It's about accelerations and decelerations, so it doesn't make you an inflationist or deflationist. There should be more of you, and actually, thank goodness there aren't, because if there were, then we wouldn't have an opportunity to, like I said, save and make money and be more right than the 95% of, like you said, what you read in the papers every day. So thanks for joining us. I appreciate that.
Good to be with you, Keith.
He is the one and only Steve Hanke, and now you know, if you didn't know, why the math drives the numbers.